Senior College of Pharmacy platform. And now I would request to Ishita proceed further. Thank you.
Thank you, ma'am. Now, I would like to request Mrs. Suvarna Vakhare, ma'am, to give the introduction of the speaker.
Thank you, Ishita. Am I audible? Am I audible? Yes. Good morning, everyone. I am happy to introduce you to today's guest speaker, Dr. Manjeet Kaur. She is a dedicated and experienced academician with zeal for research and providing quality education. Currently, she is working as professor at University Business School at Chandigarh University. She has 22 years of experience in the education sector. She is a PhD holder along with MBA in finance. Her research interest revolves around fintech, sustainable finance, and social marketing, where she has contributed significantly. Her dedication to research is evident through an impressive portfolio of 48 research papers published in renowned international and national journals, including Scopus, ABDC, Web of Science, and UGC Index journals. Beyond her research accomplishment, Dr. Kaur's passion for innovation and entrepreneurship development shines through. She actively engages in fostering innovation and entrepreneurial spirit among her students and colleagues. This dedication has also led her to earn the title of Innovation Ambassador by the Ministry of Education, further highlighting her influential role in promoting educational advancement. She has presented many papers in international national conferences and seminars. She has 2 books to her credit as well. She has six patents to her credit. She is entrusted with editorial responsibilities for several esteemed journals, including those indexed by ABDC and Scopus. As a reviewer, she plays a vital role in maintaining the quality and rigor of academic publication. She has acted as a person in many seminars and workshops. She has also received International Researcher Award 2021 by International Institute of Organized Research. It is a huge honor to have you with us, ma'am. Thank you so much for taking out your valuable time for us. Welcome you, ma'am. Over to you, Ishita.
Thank you, ma'am.
Thank you so much.
I now request Dr. Manjeet Kaur, ma'am, to start with the session.
Thank you so much. Thank you so much, Suvarna ma'am, for your kind words and for inviting me. And I would like to take this opportunity first of all to thank Singhar College of Pharmacy, their management, their principal, Dr. Rajesh Patil, and convener of IIT, Dr. Sadhana, and especially Mrs. Sadhana for inviting me here. And I'm happy to see all students gathered here to learn something new. See, today's topic session is about angel investment or VC funding opportunity for early stage entrepreneurs. See, in entrepreneurial journey, funding is the main obstacle that we have to face. So entrepreneurs, many people, they have got so many good ideas. They have zeal to do something. Their ideas are good also. They are coming up with some new innovations. But then when they have to make that idea into reality, then they are stuck. And they are stuck due to funding issues. So most of the students, they face this issue of funding. So that is why this session is very important. Now I will be sharing my PPT, and then we can discuss this. I hope it is visible. Is it visible?
Yes, ma'am. Yes, ma'am.
Okay. Am I audible now?
Yes, ma'am.
Okay, sorry, there was some internet issue. So I'm
Okay.
saying that entrepreneurs, funding is very important because mostly entrepreneurs they are stuck due to funding only, and even if they are having good ideas, they want to start their business, they do not get investment. They do not get good investors. See, because investors what they're looking for, if they go to bank for getting capital, so the bank will ask them for some security, something to keep as mortgage, which is not possible for these young entrepreneurs because they are still learning. It is their first venture, so it becomes difficult for them to get funding. But there are certain options like angel investment or venture capital funding, which is the right type of funding for new entrepreneurs. So when we are saying that early stage entrepreneurs are those entrepreneurs which are new. They just start. They have some new idea. They are first time entrepreneurs, so they do not have any reputation in the market, and they do not have any assets to mortgage. But the only good thing about them is that they are having a very good and innovative idea. So let's discuss these venture capital and angel investment. So first of all, this funding it means money required to start a business. Now, when we are talking about venture capital, as the name itself suggests, venture capital funding, it is for it is done by those companies or people who want to support new entrepreneurs, budding entrepreneurs who have got some really good idea. So basically, see these venture capitalists or when these venture capitalists can be venture capital firm which is specifically in the business of funding new innovative good firms, and or it can be some individuals, some rich people who want to invest in new businesses, right? So basically their aim of the venture, it is basically venture capital, it's a form of private equity. Venture capital is a form of private equity, and it helps these new budding entrepreneurs by providing them funding. But now the question arises why they are helping them. See, these venture capitalist firms, they're helping them to grow so that when they put their money in this new business, they will also earn some capital appreciation. So basically, this venture capital is generally used to support startups and other businesses with a potential for rapid and substantial growth. And so there is this venture capital. It is one of the, we can say, one of the common form of funding for new entrepreneurs. So these are firms that invest funds into early startups, and in which they see the potential for growth and profitable business. And they will only invest in companies which are having some good potential. If they feel that the project idea or the business plan is not good, then they will not invest. The main, you know that in businesses, in these entrepreneurs, they need this funding for purchasing assets, for their day-to-day operations, right? So venture capitalists help them in that funding. Now, how these venture capitalists earn in this process? So venture capitalists, when they give funding to these new entrepreneurs, they give it for equity. They give for it. You must have seen Shark Tank. Students, you must be watching Shark Tank. So what happens in Shark Tank? The new budding entrepreneurs, they come, they present their idea, their business idea, their forecasts, their projections are discussed. Then those Shark Tanks, they decide which business is good, which has good prospects of growing. Then on its basis, they decide that whether they should, then they give their offer. Then they give their offer, yes, we can invest this much and for this much equity. So this is actually what happens in venture capital also. So venture capital, what they do, they invest in new growing businesses for equity. And these venture capital firms or venture capitalists, basically they are looking for increase in their in value of shares. They're looking for their wealth maximization. So what happens if they, in the beginning, if they take equity, for example, when they have invested, the price of the share is 10 rupees. And for example, they have taken 1 lakh shares and they have given funding to the entrepreneurs, new startup. After some time, when the startup is developed, it is growing, it is doing good business. So the value of its shares will increase. Maybe it will increase from 10 rupees to 100, 150, right? So any number. So whatever. So after 4 or 5 years, when the business is doing good, the venture capitalists, they pull out. They sell the shares of the company in the market. So this way, they can earn very good money. So they are looking for basically capital appreciation. And the features of venture capital projects, as I told you, these budding entrepreneurs, if they go to why they go to these venture capitalists or angel investors, where they have to part away from their ownership, because when they are offering their equity to their venture capitalists, so they are basically parting. They're diluting their ownership. They're parting away from their some part of their ownership. Right? So why they are doing it? They are doing it because in for other options, like the easiest option is taking loan from bank. Bank is not giving them loan. The main reason for bank not giving them loan is that these projects, startups are usually some innovative projects. Some they are based on some innovation. So they are having high risk. See, if you're doing something new, something innovative, out of the box, someone has not done it till now, so it means it carries high risk. So as it is high risk, so that is why they do not get bank from other investors, or they do not get loan from banks or other investors. So that is why then venture capital firms or venture capitalists come into picture. So these venture capital firms, they usually invest in high risk projects whom other banks have not given the funding, and they are in those ventures which do not have liquidity. In those entrepreneurial these venture capital projects are basically those which do not have liquidity. It means they have their cash position is very tight, and these venture capital projects are done for long-term horizon.
Excuse me, ma'am.
Yes. Yes.
Ma'am, the slides are not changing.
Okay. I will run like this only. Is it visible now? I'm on
Yes, ma'am.
slide features of venture capital projects. Is it visible?
Yes, ma'am. Yes, ma'am.
Okay, thank you. So, long-term horizon. As I told you, these venture capital projects, they are based on as it, they invest in some business. Then after 4 or 5 years, when the business is doing good, they sell those shares. So basically, they are investing it in for long term. And there is another important point here. These venture capitalists, they do not only give funding, they also provide their expertise. They participate in management also, right? So here, these venture capital projects, equity participation and capital gain is involved. These venture capitalists, they for the funding provided and for their expertise, what they ask from those entrepreneurial ventures, venture capitalists ask for equity participation. They ask that give us so and so percentage of your equity, and then they are looking for capital gains. Gains means that after some time they will sell those shares at high price. And these are innovative projects, these venture capital projects. That is why they are box, something which nobody has done before. So that is how it happens. That if anybody has not done it before, so it is innovative project. So that is why the banks and other investors do not trust it. So that is why it's high risky also. And another important feature of venture capital projects is that management participation. So these venture capitalists, they do not only provide funding, they also participate in management decisions. They also provide their expertise. They help that startup to grow. They get involved in the operations of that startup. So you must have seen in the Shark Capital where the sharks, they tell in the Shark Tank, the sharks, they tell that okay, we will give you this much equity and together we can work. I can help you grow this so and so. They also discuss their strategies. So basically, venture capitalists, they participate in management, in decision making operations also. So these are the main features of venture capital projects. They are high risk, lack of liquidity, long-term horizon, equity participation and capital gains. These are innovative projects and management participation is involved. And what is the process of this venture capital, how this happens? So basically venture capital, it is uh, these entrepreneurs, they will pitch their idea to the venture capitalist, and if the venture capitalist likes the idea, then they will negotiate about the terms and conditions, how much equity, how much participation will be there. Then the final deal is done, right? So if the investor is impressed, so by the pitch and the business plan, then after they do the diligence and verification, they will negotiate, and the final funding, how much funding they have to give and how much equity and other participation they are looking for, that is decided. Now, different types of venture capital funding, the various types of venture capital, they are, we can classify venture capital funding according to the stage in which stage the money is being sought, right? If we are asking for the money in the beginning itself, if the startup is asking for the money in the beginning itself, they have not even started, we call it seed money. Okay? And if they are looking for expansion, we call it expansion financing. If they're asking funding for acquisition or buyout, we call it acquisition or buyout financing. Okay? And basically, venture capital funding, there are 6 stages of financing and 6 types of venture capital funds. First, we have seed money. Seed money, it is, as I told you in the beginning, this money is required for when the idea, they've got some idea, now they want to do some, develop prototype, or they want to do some, you can say, they have some prototype and they want to do some research, some feasibility study, then they will look for seed money. Then there is another second type of that is startup. Second type of venture capital is startup. Now, when firms have already done their, you can say, they've already done their research, their feasibility study, they have already tested their prototype, then they would like to start the business. At that time, they will looking for startup funding. So, startup funding is new firms needing funds for expenses related with marketing and product development. The next is once they start, their business has started, so they need more funds for manufacturing and expanding their sales. That is first round funding for manufacturing and early funding. Then there is second round. Second round is when now they are making good profits, and they have to increase the capacity. Then we have second round financing. Third round is when the company wants to expand, explore some new market. They want to get into, add some new feature. So they will ask for third round of funding. We call it mezzanine financing also. And then fourth round is, we call it bridge financing. For example, now the business is doing good and it wants to convert itself into a public company. It wants to ask for, it wants to make it public. It wants to have an IPO of the company. It wants to list it on stock exchange. So at the time, for taking care of all those expenses of going public, it can fourth round. So basically, these are 6 types of venture capital: seed money, startup, first round, second round, third round, and fourth round. Now, what are the benefits of venture capital? I would like to ask any of the students, can you tell me what are the benefits of venture capital? What do you feel are the benefits of venture capital? You can write in text, you can message, you can write in chat box. I hope chat box is enabled. Is chat box enabled? Ishita?
No, ma'am.
Okay, so it means they cannot interact. All right. So let me discuss the advantages. Advantages of working, advantages
Yes,
of
ma'am.
venture. So advantages of working capital are
So it
that
is open now.
you have enabled the chat box.
Yes, ma'am. Yes.
Okay. So do I have any answers from any student? What can be the advantages of?
Yes, ma'am, it is enabled.
Okay. Any answers for what are advantages of venture capital? Any answers? Any student? All right. No issues. I will tell you the advantages of venture capital is that a large sum of equity finance can be provided. These startups, they are able to get a large sum of funding, and what is the advantage for venture capitalists? So they will get, first of all, they will be associated with some good startups, uh, and they will get capital gain, whatever equity they are getting for the first time by investing. So the share, when the share prices will rise, they will get capital gain, and these venture capitalists, they bring wealth and expertise to the company. They're not, it is not only limited to getting funding, so they also provide their expertise to their startups. And these venture capitalists, they also have a wide network of contacts. They are having their own contacts, like they must be knowing some good suppliers, some good warehouses, distributors, some customers, so which is very helpful for startups. And venture capital, it does not stop at once the venture capitalist has given funding. Business requires more funding in later stage, they can ask for additional funds. As we discussed, there are 6 stages of funding, so they can ask fund for any other stage as well. Now, this was about venture capitalists. Another type of funding which is suitable for startups and early entrepreneurs, that is angel investors. So angel investors, these are usually people or it can be company. So they provide capital for small startups. See, the difference here is that venture capitalists, they give large amount of funding, their funding is huge, and angel investors, they make small investment. First, they do not invest in big startups, they invest in small startups. And again, these angel investors, they are also looking for equity in the company. They are also looking for equity in their company, and they do only one time investment. They usually do one time investment, and in some rare cases they may provide financial support later also, but in early stages only. And these angel investors are basically those people or entities which are looking for higher returns on their money. So basically, these angel investors, they feel that instead of putting money in stock market, why not put it in some new startup which will grow rapidly and give us good return. So basically, again, just like venture capitalists, angel investors are people who like to invest in innovative projects. So now this looks similar to venture capital. So let's see the difference between angel investors and venture capital. So example is, for example, angel investors, they're comfortable investing smaller sums. They are doing small investments, whereas venture capitalists, they put invest large sum into the business. And angel investors, their investment decision is quick within 1 or 2 meetings. In 1 or 2 meetings with the entrepreneur, they provide the funding. On the other hand, venture capital, as the funds are huge, so there are many rounds of negotiations. When the pitch has to be presented, the negotiations are there, due diligence is to be done by venture capitalists. Then they provide money. And there is, in angel investors, there is no control of subsequent funding rounds. It means usually angel investors, they give investment one time initially only, usually. But on the other hand, in venture capitalists, they can ask for this funding again also in other stage also. And angel investment is a simple term for investment, but venture capitalist is a lengthy and complex process. And venture capitalists also reserve their seat in the board of directors because they take part in the management. So these are the main points of difference between angel investors and venture capital. Do you have any questions? Any questions? No questions? Okay. Then we will move to next, the funding process. So how this funding process works? This is something important for budding in entrepreneurs. So the venture capital funding process typically involves 4 phases in the company's development. So venture capital first, idea generation is there, then startup, then ramp up and exit. So idea generation is when the entrepreneurs get some idea, so they can come to the venture capitalist for seed money, and startup when they have started, they launch this new business, they can come to the venture capitalist for funding. Ramp up means they now the venture capitalist, it uh, it tries to grow the company. It helps it in its growth. Then next stage for is for venture capitalist exit. Once the company has grown and its shares are soaring high, they're giving it good value, so it will exit by selling its shares. So this is funding process. Now, whenever as an entrepreneur, if you are going to uh, if you are going to present going to some venture capitalists or angel investors for funding. So these are some of the checklists that you have to follow. You reach out to investors. So first of all, you need to prepare a pitch deck. Pitch deck means you need to prepare a proper pitch presentation where you will communicate, you will present about your business idea. So the key points that the pitch deck should include are the company overview, idea about the company, problem and how you solve it, the problem, because every innovation, every business is based on solving some problem. For example, Zomato came into existence. Why? Because there was a problem. People were not having time to go to restaurants to eat good food. They were not able to cook food. So they wanted food delivered at home. So this was the problem. So the solution was provided by Zomato. So similarly for different businesses, basically these innovative businesses, they are trying to solve some problem. So in our pitch, as an entrepreneur, you need to present the problem, what is the problem, and how your business solves it. And the pitch should also include the product details, what product you are offering to the customers, its specifications, its importance, and you will also give team overview, who all are part of the startup, the key members of the startup. Basic numbers, you will give basic numbers. Basic numbers means you will provide them basic projections, your cost projections, profit projections, and competitive analysis and USP. You need to also show what other competitors are doing in the sector and what is your unique selling point. USP means unique selling point, how your product or your business is going to be different from others. And then funding ask. In your pitch deck, you should also it should also have the amount you are seeking for funding. And another important part in when you reach out to investors is that you should have a business plan. There should be proper business. You should be having a proper business plan. So your business plan should be realistic. You should not overstate business plan numbers. And whatever terms we're using in the business plan, it should be simple and understandable. And another important point before we reach out to investors for funding is shortlist investors. First of all, you need to identify the investors who all are venture capitalists in our area, who all are angel investors in our area. First, you have to identify them. Once you identify them, then only you can pitch them your business plan. So, how we should raise funds? First, approach whom you will approach, people you may know, competition, advisors, mentors, or cold mails. Cold emails means you send mails to investors seeking funding. These are cold mails. Whoever will reply, then you will pursue that. And the pitch, the pitch should have the following features. It should be an elevator pitch. Elevator pitch should, it means it should be move us towards, it should show clearly that how our business is going to be successful, and it should be storytelling based. It should be storytelling based, because usually people, they love to listen to stories. So when you will pitch your business idea, so they should be interested. And the pitch should be in PowerPoint slides. You cannot go and on a paper or a Word documents and you can tell. You have to present it on PowerPoint slides. And you need to discuss the opportunity. In whenever you're going to raise funds from the angel investors or venture capitalists, you need to discuss about your business idea, that which problem it is trying to solve and why this problem was there, and what is the market size and the potential for it to grow in future should be added. And you should also discuss about solution. What is your solution to the problem, and what are the current solutions, and how your solution is different, and what do you have currently, and the technology, what type of technology you're having, uh, like the technology you're providing to them to solve their problem. And in your pitch, you should also talk about competition. Who all are your competitors? In fact, provide a complete competitor analysis, and also highlight how your idea is different from them and how you're going to compare that competition. And you should also discuss about your business model in your pitch, like how will you get customers, how will you make money, and how much will you make per person, and what is the cost of providing the service or product, and what is the cost of customer acquisition. So this, you in your business model, you need to discuss these things. Whenever you're pitching your business idea to get funding, you need to talk about all these things in your business. You need to discuss your business model, your competitors, your revenue, your service or product, and customer acquisition. You should also talk about, in your pitch, you need to talk about your operations and achievements. You need to tell about your clients. If you are already existing, like as you discussed in venture capital, types of venture capital, that it can be taken at any stage, not only in the beginning. It can be for expansion, for making it public. So you need, if you are in that stage, you should talk about your operations and achievements. You should tell your some reputed clients. You can talk about your operations and revenues. You can talk about your product or service status. You can talk about some press reports, references, website performances, or any other achievements. Now, these are some common pitfalls. These things we should avoid while making a pitch. First of all, not preparing for the series, a post-seed or angel round. starting the fundraise process too late, not identifying the right investors, and not being ready for due diligence. Okay, so I'm repeating. So these are important for the pitch, which is to be storytelling, PowerPoint slides, and elevator pitch. It should discuss the opportunity, the solution, competition, business model, operations and achievements, and we also discuss the common pitfalls to avoid. So this was about angel investment, venture capital, how we can raise funds from them. If you have any questions, you can ask.
Yes, students, any questions?
Faculties can also ask the question.
Good morning, madam. Hello.
Good morning. Yes, good morning, sir.
Hi, good morning. Dr. Praveen Bade this side.
Yes, good morning, sir.
Hi. So I got a couple of questions. Hello.
Yes, I'm listening.
Hello.
Yes, sir,
Yes,
you are
I'm
audible.
listening.
Yeah. So just from the student point of view, so a student who has got an idea, and now he actually want to simultaneously he's trying to develop his idea, but he want to approach the funding. So what should be his first approach, to whom he should actually go while approaching for the funds?
See, if the student is having some good idea, they should approach venture capitalists. So this is very important. So they first of all they need to identify the investors. See, they have to do some homework. Student has to do some homework. They have to see the find angel investors in their area, right? If you are living, for example, in Maharashtra, you cannot go to someone in Delhi to ask for that. So you have to look for some angel investors who are doing investment in new ventures in their area. There are venture capital.
Ma'am, you're not audible.
Okay, am I audible now?
Yes,
Am
ma'am.
I audible? So I'm
Yes,
saying,
Yes.
okay. So I'm saying the most important in first step is to identify the investors itself. So the entrepreneur, the student must identify the angel investors or the venture capital firms in that area. So in that, if you are in, for example, Maharashtra, you have to look for angel investors or venture capitalists in your area only. Okay, because they will be more comfortable in investing and keeping an eye on you if you are in the same vicinity. So the first and important step is to identify venture capital firm and angel investors.
Okay. And how they actually also get initial mentorship where actually they can raise their questions regarding the product or regarding the funding or anything where it can be answered. So is there any like mentorship available which can be done online, or are there ways where the startup can actually get the initial mentorships?
See, with Innovation Council, Ministry of Education Innovation Council, they have started they have this initiative of mentor and mentee, where as an as an innovation institution council, uh, it is the responsibility of the institution innovation council to allocate mentors to their students. See, the colleges, they must be having different, they must be having collaborations or MOUs with industry, right? So from industry, you can allocate them some mentors. You can have an MOU with industry. You must be having internship MOU related to internship or placements with industry. So in your MOU, you can also add this point that you need mentors from that industry for your students. So this way, your innovation, this institution innovation council can go ahead with this.
Okay. Thank you. Thanks, ma'am.
Thank you, sir.
Thank you, ma'am.
Um, Thank you, ma'am. Now I would like to request Mrs. Rutuja More, ma'am, to give the vote of thanks.
Thank you, Ishita. Am I audible? Good afternoon, one and all. I, Rutuja Mule, Assistant Professor, feel honored to propose vote of thanks on the behalf of Siagar Technical Education Society's Siagar College of Pharmacy for today's session. My heart fills with lots of gratitude and respect to our guest speaker, Dr. Manjit Kaur ma'am, for not only sparing their invaluable time but also enlightening us with her commendable talk on the topic. Thank you, ma'am. My sincere thanks to our Honorable Founder President Professor M.N. Navle Sir, Founder Secretary Dr. Mrs. Sunanda Navle Ma'am, Vice President Dr. Mrs. Navle Rachna Navle Ashtekar Ma'am, Vice President Mr. Rohit Navle Sir for their continuous motivation. My humble thanks to our principal, Dr. Rajesh Patil sir, for their continuous encouragement and support. I would like to thank Dr. Sadhna Raut ma'am, IIC convener and activity coordinator, Mrs. Suvarna Vakare ma'am, for arranging such kind of sessions. My sincere thanks to our faculty and the students who have participated in this session. Thank you one and all.
Thank you.
Now I would like to request everyone to switch on their cameras for a group photo. Ma'am, can you please switch off the PPT?
Wait.
Ma'am, can you please stop the screen sharing? Thank you, ma'am. Thank you so much, everyone, for attending this lecture. We conclude this session. Thank you.